this presentation as well as the presentation like video in YouTube like last week, it's probably best for you to take notes because not everything that we say will be text on the slide. So Colleen will start off.
Hi. All right, so the basics of stocks. So when you're buying a stock like from a company, you're basically buying partial ownership of that company. And stocks are also a collection of shares, which is the capital or money of a company divided into like small pieces. Shares outstanding is the number of shares owned by the public, and this number can fluctuate wildly. Market capitalization, or market cap, is the market's value of the company, and that's basically the total value of all the company's shares of stock. And you can calculate this by multiplying stock price and the shares outstanding. So for example, as this was from yesterday, I think, Apple had $506.09 per share and 4.276 billion shares outstanding. So you get a 2.16 trillion market cap.
Yeah, and so in layman terms, like Colleen was saying, basically owning a stock is just owning part of that company. And it might seem like kind of weird, like the fact that you actually own a part of a company that like used to be maybe private and like just belonged to the people who founded the company. But you might be wondering yourself, so why, yeah, Derry?
I don't know. I was just wondering if you're a company and you have, let's say, like 100 shares offered because you're a small company. If you get larger, how do you increase the amount of shares you offer without annoying the already shareholders that you already have? Because if you increase the amount of shares, then the value of each of their shares goes down, right?
Yeah, that's actually a really great question, particularly because Colleen has Apple as her example. So you're right. What happens is, let's say you start off with like a dozen donuts, right? And then you have like 12 friends and you give each of your friends a donut. And each one of them is happy because they have a whole donut. And then those donuts maybe get more valuable. I don't know how that happens, but they get more valuable. And then maybe what happens is like, 12 more friends come along, like maybe, I don't know, but like 12 other hungry kids come along and they want to eat donuts. And so what do? You have your old friends tell them don't eat your donut, and you divide the donut into two and each person gets a half, and they're not going to be happy with that, right? But at a certain point, maybe the market increases so much that it doesn't exasperate them as much. And you might wonder, like, wait, that's so not intuitive at all, like people losing money, why would they do that? And that does seem kind of strange, but companies like Apple have actually proposed, correct me if I'm wrong, Matt or Ronak, I don't know if they have actually gone through with this yet. Yeah, but they are thinking about, or they already have started dividing their stocks. But yeah, we'll go more into that later. That's a little more complicated. So next.
Okay, so why do companies sell stocks and why would you buy stocks? If anyone in the crowd wants to volunteer and like you can even guess if you want to, either one of these, why you would sell or buy stocks. You can be wrong, it's fine.
I think they sell stocks so they can earn money from them.
Is that Joe? Yeah, that's basically what Gavin's saying too. So the share can appreciate and you can profit off of it. Cassie Press. Okay, so what companies sell stocks so they can basically raise money for business goals, such as funding new products, investing in growth, or if they want to pay off debt. They can also attract investors if they want to bring their expertise into their company, or they can purchase other firms through stock shares instead of money. And sometimes they give their employees stocks to encourage them to work harder and get them invested in their company. And Cassie, click again. And so why would you buy stocks? So stocks in history have given the highest and most stable returns of any asset, which is a resource with economic value. They're also really beginner friendly. You don't have to be rich. You don't have to save up money or take out a loan to start doing stocks. They're also flexible. So you can quickly sell your stocks and find another company if you don't like their business model. And lastly, they're low maintenance. So if you have like high quality investments, they're pretty self-sufficient and you can just chill. Okay, so there's two types of stocks, common stock and preferred stock. So common stock is common because it's what you usually buy and what people most refer to. And they give you some voting rights. So if you own like a stock in a company, you have a voting right to that company's big decisions. And sometimes those decisions can impact the price of shares someone owns. And the more shares you have, the more voting power you get. There's also more risk in common stock because there's a lot of changes in stock price and dividends, which I will get to later. And they're also last in line. So if your company goes bankrupt, the order of getting paid is the preferred shareholders, the bondholders, and then the common shareholders. So usually the common shareholders get like nothing. So,
Yeah.
okay.
Oh, are you done?
No, go ahead.
No, you can go first.
I'm just gonna move on to preferred stock.
Okay, so a little bit about the bankruptcy thing. It's actually really interesting. Like, I personally am very interested in bankruptcy because it's very complicated. It's kind of like unemployment. You think, oh, the person just doesn't work, like that's it. But no, unemployment's really complicated, and so is bankruptcy. And so like we're gonna get into bankruptcy more in the future, but like as a little preview, how it works is when a company files for bankruptcy, they basically they take it to court, and then they basically ask for like they ask for almost like a pardon to basically make sure that the people who they owe money to can't go after them for it. So they can't get like penalized for it. And so like you wonder like, okay, so how do they do that? So what happens is that whatever assets they have left, they have to like pay back some people that they owe, right? And so as Colleen was saying, there's like a line to bankruptcy. So imagine if like Colleen owes like me, Derry, Joe, and Ritika all money. And let's say Derry's the one with preferred stock and I'm the one with common stock. And Derry's gonna get the money first because he has the preferred stock. He has more power, which is kind of strange because preferred stock owners, they don't have voting rights. Continue, Colleen.
Okay, so for preferred stocks, the buyers are usually institutions. They also receive dividends regularly, which are distributions of the company's earnings to the shareholders, and these are paid out of the company's revenue. They also, like Cassie said, they don't get voting rights because they're first in line to get paid, and if they have both, that kind of makes them overpowered. And they're also less risk because they're like a hybrid investment, which is they're part bond and part stock.
Which we'll get into.
So, as you may know, security prices, particularly those of stocks, are frequently on the move during trading hours. A stock ticker is basically a report of the price of certain securities updated continuously throughout the trading session by the various stock market exchanges like NYSE, NASDAQ. So the origin of this stock ticker is actually from the ticker tape, which refers to the paper ribbon, which was basically the 19th century mechanical way of reporting stock prices. But today, a stock ticker is digitally displayed during the time stock market exchanges are open, and as well as after hours. So apart from price movements of the stock ticker actually provides other relevant information, such as trading volume that investors and traders use to stay informed about the current market conditions and the interest that in that particular security. So as you can see here, we have the previous and close and open, which basically refers to the start price of the trading day and the prior trading day's final price of security when the market officially opens and closes for the day. Keep note that the market is usually open, typically from 9:30 a.m. to 4 p.m. Eastern time. So when we get into the virtual stock market game, 9:30 a.m. to 4 p.m. Eastern time is the only time you can trade. And the 52-week high and low is pretty self-explanatory, which means it's the highest and lowest reported price of the stock in the last year.
Yeah, real quick, do you guys see what's on my screen? Yeah? Okay, great. To be honest, I'm not really sure why you can't see anything on the screen.
I only see like the title of the slide.
Oh, you see the title?
I just see
Maybe
basics
it's really
of
slow.
stocks, bonds, and funds.
Oh, that's really strange. Okay, well, we're gonna exit this slide soon anyway. I mean, we're gonna exit this meeting soon anyway and have to like restart it because the meeting time is weird. So I guess you could just like listen for the next 3 minutes.
Okay.
So we actually have more stock ticker information to tell. So EPS is basically the earnings per share, which is net income over shares outstanding. As Colleen said, is basically the company's stock currently held by all of its shareholders. So all you need to know for EPS is that it indicates how much money a company makes for each share of its stock. So a higher EPS would indicate more value because investors pay more for a company with higher profits. A P/E ratio is price per earnings, which indicates how much dollar amount an investor can expect to invest in a company in order to receive $1 back. So for example, a P/E ratio of multiple of 20 times represents an amount of 20. I give this company $20 for $1 earning. So an important note for the stock market game is if you see a high P/E ratio for a stock, it represents a bullish company, whereas a low P/E ratio could represent a bearish company. Bullish and bearish are another two investment terms, but we'll get into that later. And a dividend yield is basically shows how much a company pays out in dividends each year relative to its stock price. Volume is the number of shares traded over a period of time, and beta, I call this the risk ticker, which compares the volatility of a stock to the S&P 500. The S&P 500 is basically an index fund which tracks the top 500 companies of the United States.
And in case you don't know what an index fund is, we'll get into that.
Beta is actually really complex, so I'm recommending Robert Schiller's online course, Financial Markets at Yale, who talks about beta and the details of it.
So Matt, in really simple terms, can you just explain, is a high or low PE ratio good?
A high P/E ratio represents an overvalued or well, although it can represent a bullish company, keep note that it can also represent an overvalued company. Whereas a low P/E ratio can also represent a bearish company. Well, bullish basically means that there is optimistic sentiment towards that company, whereas bearish represents a negative and a pessimistic sentiment.
Yeah, and we'll get more into that later. So, sorry for the inconvenience, but can you guys rejoin the link? Okay. I'm going to end this meeting. See you guys soon.